So welcome to an introductory session once again for the module Advanced Risk Management and Corporate Governance. So we are looking at splitting this subject into a few components, and I will be your guide for a particular session or section of this guide or module. I'm looking at the financial risk management module under advanced risk management and corporate governance. Why I will be doing it for you is because this is my area of expertise in terms of financial management and financial risk management. I've been teaching the module for over 10 years now, and fortunately, my students have been winning Sri Lanka's #1 ranked, and for certain modules that are international, students have also won world rank #1. So I have a few credentials behind me that make me let's say eligible to teach this module, and it's a pleasure for me to be here amongst you to teach this module. When it comes to this module, or a little before that, also a little more about myself in case you haven't watched my other sessions. I come with quite a bit of corporate experience as well, and today I am leading the finance function for a particular cluster under one of the largest apparel manufacturers and exporters in Sri Lanka. So teaching is my hobby, and I believe I can deliver the message well to students, and there has been good pass rates in the past, and I believe that if you trust the process, success will always come through to you, right? So we're not going to do anything fancy, we're not going to do anything out of this world, right? But what we're going to do is focus on the basics, or let's say the principles of financial risk management, and with that you should be able to secure significant amount of marks or sufficient amount of marks to help you pass that hurdle, okay? So having said all of that, what I'm going to do is deconstruct your module, Advanced Risk Management and Corporate Governance. I'm not sure if you have seen the module from an angle like this. What I always tell students is, if you can put what you're studying in a flow chart or a mind map, then you have understood what you're going to do, okay? So what I did was I deconstructed this module into very simple flow diagram. So we have Advanced Risk Management and Corporate Governance, that's the main module. Under that you have 5 sections. You have regulatory compliance and legal frameworks. We have internal audit, Advanced Risk Management, Corporate Governance, ethics for accountant in business. Now, I think we have expertise or expert resources on these other areas, and I've been selected to walk you through this particular module, which is Advanced Risk Management. And if you take Advanced Risk Management, we break it into a few more buckets: enterprise risk management, type of business risk, budgeting and forecasting, financial risk management. So my speciality comes with financial risk management. So what I'm going to do, or what I've opted to do, is rather than taking the entire advanced risk management module, I'm only taking this section, which is financial risk management. I hope it's very clear, right? So you will see me doing this for you, financial risk management. The rest of it, we have other resources who will take you through. Now, when it comes to financial risk management, it is a very interesting area. If you are following my module for the finance management module, strategic finance management, then I have been talking about risk continuously, right? But if you have already finished that module, or if you are following it with somebody else, then obviously I'm new to you, but we will define risk once again, right? We'll start defining risk once again, and we'll bucket it into 3 parts. One is your interest rate risk. Obviously, everybody is aware of the word interest. You can't be a finance professional and not know the word interest. Interest is a common terminology in finance. Then you have foreign currency risk. Now, this foreign currency risk is something that you may have not really witnessed. Okay, you must have heard of it, but you may have not witnessed it. So what I will try to do for you is break it down into sizable chunks, or help you understand it in a way that even if you have not dealt with foreign currency, you should be able to understand. So I will dumb it down to that level, just so that you understand the concept, because all I want you to know is just knowing the computations or the theory behind it won't help you. Okay, you need to understand why you do things and how it is being done. So foreign currency risk, students, I've been teaching this module for more than 10 years, so across not only CA but across everything else, where I find that interest rate risk people understand, but when it comes to foreign currency, people tend to take a step back and say, I'm afraid. Okay, but for some reason, when I studied financial management back in 2013, 14, 15, I did it for my degree, and then I did it for my professional qualification also. Something that I absolutely loved was foreign exchange. Okay, from there onwards, I loved foreign exchange. And I think that's what has led me to, come into this place and say, okay, I will take up financial risk management, and I will walk students through interest rate and foreign currency risk. And then we have a subsection called digital finance risk. So when it comes to digital finance risk, I am not too worried about you understanding that part, because everybody lives now in a digital world, right? We are all living in a digital world. So the world has transformed in such a fashion that without being digitally equipped, or let's say integrated, you are far, far behind. For example, watching this lecture digitally, right? You are watching this lecture digitally. So which means you are integrated with some form of technology and some digital aspect of it. Okay? Right. So what takes us into interest rate risk management? So I have put out 3 key areas that we are going to cover. I'm not detailing it out to scare you. Okay, I won't scare you on the day one. Nothing to be scared, but I don't want to scare you. Okay, you might look at the topics and wonder, oh my God, I can't do all of this. Okay, you can do all of it. So let's keep it at this high level for now, and then let's go into the details as then we go into the chapter. So interest rate risk management process, we will talk about the reason as to why there is a creation of interest rate risk in the environment. Okay, I'm not going to go into definitions today, because the purpose of this module session today is to just give you an overview of what you're getting yourself into. Okay, then interest rate risk theory and fluctuations. Then we try to understand, okay, first you understand what is the risk, then you understand why that risk is being created through some theoretical knowledge, and also understand the fluctuations. Now, if you have followed financial management before, you should know that the term risk is in itself called fluctuations or deviations, right? So whenever you have ups and downs, there is some form of a risk, right? So here what we are talking about is, why is there fluctuations and what are the causes of those fluctuations. And then the most important part is for you to look at your interest rate risk hedging techniques. So here you will have a mix of writing, and you will also have a mix of calculations. Okay, so you might be asked in the exam. I have a few sample questions I have put at the back of this slide, where I will show you later on, but for you to just get an understanding, the examiner can always ask you the theoretical aspect behind a particular concept and also the application of it through computations. I'll just give you an example. The examiner might say, use interest rate collars as a hedging technique. But before he goes into that technique, he might say, okay, discuss, right? He might say, discuss the possibility of using an interest rate collar for the given scenario. So you'll be given a scenario, no? So it can be a 50-mark question, it can be a 25-mark question. Okay, so in a 50-mark question or a 25-mark question, what the examiner can push towards you is, why, or tell me why this particular technique may work. Now this is important. You need to not only understand the calculations behind it, you will also need to understand why something is done in such a way. Okay, that is important. The why is key. Why is it happening in that fashion? So what we're looking at here is hedging techniques. So we have a number of hedging techniques. It can be interest rate futures, interest rate options, interest rate collars, interest rate swaps. You can have basic FRAs, you can have IRGs, so on and so forth. So you have multiple different techniques which we are going to learn under interest rate hedging techniques, right? And I'm going to make those computations somewhat straightforward and simple for you, so that you understand the basics of it first, and then we'll apply it into a case and see how it works. Okay. So just like interest rate risk, you also have foreign currency risk. So when you say foreign currency risk management, again we're talking about exchange rates of different currencies. So first thing we'll understand is, what is that management process? Why is that risk coming up? Then obviously the theory and fluctuations. So there are different theories that we learn under foreign currency risk management. I'll just give you one example. One might say, okay, it is the purchasing power parity theory. Or one might say, okay, it's something called a four-way equivalence model. Or one might say, okay, it's an expectations theory, right? So different theories, why people understand or why people see those fluctuations in exchange rate. So we'll come into detail in our module sessions. And then just like your interest rate risk hedging techniques, something that you will have here is also your foreign currency risk hedging techniques. So just like I mentioned a few for interest rate, here you can have something like a forward rate, you can have a money market hedge, you can have a currency swap, you can have a forex swap, you can have foreign currency derivatives such as futures, options, so on and so forth, right? So these are few things that we'll be looking to cover during our syllabus coverage. Now again, what the examiner can request from you is not only calculation but also the theoretical aspects of it, to say, okay, why is something done, and the reason behind it, and the reason behind it. Okay, right. And then we have the last part on digitalization, which is digital risk, finance risk governance, then your fintech part, then you have governance complexity and corporate culture, and then finally you have regtech. Now regulations, technology integration, right? So what we need to then cover is few digitalization aspects, which I may take it up, or there'll be someone who will cover it in their digital aspects part, but let's assume that I will do it, and then in that sense we will cover few of these areas as well, which is mainly on digital finance and fintech. So finance technology and then your regulatory framework of it. The buzzword in town is all about bitcoins, right? And we call them token currencies, so on and so forth, right? So with all of these fancy words that are coming out in the industry, technology or digitalization has become key. So how do you manage risk with regard to that is something that we will cover as well. Okay. So what I wanted to quickly do is in the next 5-10 minutes is take you through a synopsis of an assessment, right? So if you look at this question, now there is a long scenario, I didn't want to bring the scenario here. It says conduct a comprehensive analysis of our financial risk profile focusing on foreign exchange rate risk, interest rate risk, liquidity risk, credit risk, investment risk. For each risk category, what they are saying is identify the key exposure drivers, apply suitable measurement methodologies, and recommend a relevant risk appetite statement. Now, risk appetite statement and all of that will be covered when you talk about enterprise risk and all that. So, obviously, they are going to combine areas of your module. But my interest is on the first two parts, which is foreign exchange risk and interest rate risk. Right? So, they will say, okay, arising from USD priced inputs and USD denominated EPC contracts against LKR CPI indexed PPA revenues. Now you might be looking at this and wondering what are these abbreviations, EPC, CPI, PPA. Okay. So EPC is basically mentioned in the case. PPA is also mentioned in the case, right? It's nothing to do with risk management. So they will give the definition on the case, right? And then they're asking interest rate risk arising from AWPLR linked short-term borrowings. And asset liability mismatches in leasing activities. Okay, so there is a bit of a complexity involved with the interest rate risk management part here, but we should be able to tackle it as we study the techniques. Right? So if you really look at it, are they asking you for calculations? Not really, no. They are asking identify the exposure drivers. Why? What is the exposure driver for each of these two? Right? The reason for risk. Apply suitable measurement methodologies. How are you going to measure these methodologies? And recommend the relevant risk appetite statement. So they are not asking any calculations. So if I remember, this question was 10 marks. There are 5 parts, no? 5 parts, so 2 marks, 2 marks, 2 marks for each. Okay, so you can't have a computation. So when they give you a question like this, you can't start taking your calculators out and start calculating. Now, as finance or as accountants, the first thing that people do is pick up a calculator. Any subject, that's the last thing you have to do, right? Because you have to first understand, what am I going to calculate? Because if you don't know what you're going to calculate, why are you picking up a calculator? Okay. Then the corresponding question after that says, recommend a coherent hedging strategy to manage foreign exchange and interest rate risks by comparing effectiveness and costs of forward options, costed collars and natural hedges. Establishing a policy parameter such as hedge ratios by time horizon, tenor layering, counterparty exposure limits, and stop loss rules. Ensuring compliance with SL-25-3.2 9 financial instruments, hedge accounting requirements through formal designation, documentation, and effectiveness of testing. Now, when you look at the language of this question, the English words on this question will make you feel scared. Now, don't feel scared because this again I think was 10 marks. Not 10 marks, this was I think 15 marks. You can do the computations on these, right? And again they are asking you recommendation, what is better, right? You will have to do it for both ideally foreign exchange and interest rate. Okay. So this kind of question can come in the exam. So we have to, before we start studying the subject, you have to understand the depth of the exam terminologies, and based on that you can cater to your studying, right? So you need to know, okay, I need to go into real depth of this module if I really want to answer this question. Especially a question like this, you can't answer with surface level knowledge. You can't answer with surface level knowledge. You need to answer it with in detail knowledge, right? And the last part which I put actually here, which I didn't mention in my previous area, is something about treasury risk management, right? So here they're asking you advice on how group treasury should evolve to support international operations by implementation cash pooling, establishing intercompany funding policy, centralizing foreign exchange execution with local limits, counterparty credit controls, optimizing asset liability management for leasing, maturity matching, duration limits. So this is on treasury management systems, yeah, TMS, and a dashboard that integrate treasury metrics with enterprise risk management. Propose one initiative that reduces overall financial risk without harming growth. So these things can come up in your exam as well. So when we are studying foreign exchange risk and interest rate risk, it's also important to understand and study the function of the treasury in the company. Especially in a global operations, treasury becomes such a big aspect. So we need to always look at understanding how treasury functions work and how that's going to impact your business, the way you operate your business, right? So these are kind of the questions that you will get at your exam. So when we are studying, again, I will like to remind you, when you're studying for this particular module, make sure that you are always engaged in a kind of a depth analysis. Don't study the subject at a surface level, or don't assume that calculation only will help you pass this exam. So I'm telling you now outright and upfront, calculations alone won't help you pass this exam. Okay. So with that, I will conclude for today my introductory session, and I will see you when we start the section under financial risk management. Thank you.